first sat down with Phil Duffy, head of Woodwell Climate Research Center and brilliant climate scientist, we said to him, Phil, we want to understand heat, drought, wildfire, hurricanes, floods, access to water, sea level rise, and air quality in basis points. And from across the table at 280 Congress Street in Boston, our home office, Phil Duffy said to us, what's a basis point? And that's when we knew we were onto something important. These two analytical disciplines, climate science and finance, did not speak the same language. We did not know representative concentration pathways, RCP scenarios. They did not know basis points, which of course is an everyday language for us. And if we were going to navigate the climate crisis successfully, we were going to need to work together. In September of 2018, we launched a research collaboration with Woodwell with the goal of bridging the gap between climate science and finance. Today, I'd like to share with you 3 key learnings, how they've shaped our strategy, and how you might want them to shape yours as well. Number 1, climate risks are not priced into capital markets. Number 2, awareness of, and therefore resilience to, physical climate risks is low. And number 3, climate adaptation and mitigation will be critical. So let me first describe how this climate partnership with Woodwell works. In the first year, again, back in early 2019, we decided we wanted to study 6 variables in that first year, spending 2 months on each variable to form that critical foundation from which we could move forward. We identified the 6 variables: heat, drought, wildfire, hurricane, floods, access to water. And when we launched on a new variable, say heat, the Woodwell scientists would give us a lot of peer-reviewed, rigorous research to read. Of course, there's a lot of climate research in the marketplace. They helped us identify the highest quality research to get our knowledge up to speed. We would get hundreds, if not thousands, of pages, and they would give us exactly 1 week to spend with this new information. We'd come back together after a week, and armed with our limited new knowledge, we would highlight and identify capital markets questions we thought we would like to answer. The scientists would then say, well, if you want to answer those types of questions, let's think about this metric. So for each of those variables I mentioned before, heat, drought, wildfire, etc., you can measure them in different ways. They would allow us and help us figure out which metric would be most appropriate to answer the questions we wanted to answer. Once we'd settled on a metric, the Woodwell scientists would create granular grid maps, maps like the ones you and I use to navigate, to do cross-country trips, or to drive around, except for instead of including roads and highways, they actually include climate information. They would show how the index or the metric we had chosen would change time period over time period, geography by geography. We would take their maps and layer our capital markets information. Essentially, all of the financial statistics that we use on a day-to-day basis to make investment decisions would be placed on top of these maps for the securities we own on your behalf. And by doing so, we were hoping to identify which securities may have more or less climate risk and look into whether or not those climate risks were being priced. And almost immediately, we found that capital markets are not accurately pricing climate risks. Key learning number 1. In fact, we found securities where there is locational value to the security, such as a municipal bond, where you're financing a particular project in a particular location. Those securities would have the same traditional financial metrics, credit quality, yield, maturity, and very different climate outcomes. This is a market inefficiency. Clearly, those 2 securities should not be priced the same way. And it was our first real evidence that capital markets actors like ourselves were not sufficiently looking through the climate lens when analyzing investments. Let me tell you a little bit more about how this works and bring it to life. That first variable that we studied was heat. The climate scientist helped us pick the right metric, which is a combination between temperature and humidity. In fact, this combination, the heat index, came up in Chris Gulgazian's interview with Kim Stanley Robinson. We chose that metric because the combination of those two characteristics actually have more consequences on the human body and on some forms of infrastructure. This table shows you how the heat index works. Across the horizontal axis, you will see temperature. It's measured in Fahrenheit, but I will do that Celsius conversion for you. And the vertical axis, you will see relative humidity. And if you go to the cells where those two characteristics intersect, you find the index, and then at the bottom, you see the consequences of the index on the human body, where the danger zone and the extreme danger zone, those really deep orange and deep red categories, are the ones that we're most interested in. So if you look at 88 degrees Fahrenheit, that's roughly 31 degrees Celsius. You don't get into that danger or extreme danger zone until you get to 75% relative humidity. But if you look at 104 degrees Fahrenheit, 41 degrees Celsius, temperatures that were measured in France and other parts of Europe last summer, you see that the relative humidity only needs to be 45% to get into the danger and extreme danger zones. Using this metric, Woodwell created granular grid maps. Here we show not a granular map, but a global map, just to show you how this metric is changing over time and in which geographies will experience the most change. You can see there's a lot of red and orange on this slide, on this map. This means that in the 2020 to 2029 decade, the decade that we're in right now, we'll see a lot more incidents of danger and extreme danger days. This map shows us that climate change is not too far away to matter. It is within an investable time horizon. For many years, we'd heard climate change isn't investable, it's too far out, it's not going to impact securities within an investable time horizon. In fact, even Mark Carney's statement, the tragedy of the horizons, seems to imply this. And while we know not all securities will be impacted over the next 3 to 5 years, some securities will. And we think it's important to consider this as we analyze the securities that we own on your behalf. Let me bring this further to life. Here's actually the example that I was mentioning before. Here we have two securities, in this case, municipal bonds. Again, municipal bonds finance projects in specific locations. So they have a locational value inherent to the security itself. At the bottom, you see those financial characteristics, the credit quality, the yield, the maturity. They're the same. But you also see that one security has much more heat risk and much more hurricane risk than the other. Those securities in our minds should not be priced the same. If you ask me, I'd rather own the same security for the same price with lower risk. This got us really curious. Where else could we find these relative inefficiencies? And 3 words ending in the suffix ION really framed our approach: visualization, location, and duration. Through visualization, through the use of these maps, we could zoom in on securities where their location might be impacted and where there's locational value and some duration to the security itself. In the case of equities, that caused us to focus on companies and securities that have high levels of property, plant, and equipment because of that physical location element to PPE. In fact, we found an industrial company who had just recently built a $7 billion asset, a plant, in a flood zone. We looked through all of the publicly available information on this company. We looked at their transcripts. We looked at their disclosures. We looked at their annual reports to see if they'd referenced some sort of resilience measures, if they'd referenced insurance that they were buying on behalf, if they thought that this fixed asset would be implicated during the time frame, or if it would be short enough where these floods concerns would not matter. We saw no reference. So we armed ourselves with the map and with our questions, and we met with the company management team and asked them, how did you think about locating this site in a flood zone. And it quickly became apparent to us that they hadn't considered it at all. And so that told us two things. It told us that this asset may be written down due to flood concerns, but it also told us that the company management team wasn't as forward-thinking or as prepared as we would like them to be. We've built these security by security insights from the bottom up, and we've launched a process internally that we refer to as climate portfolio reviews, CPRs. You'll find that we like acronyms. In these CPRs, we look at various portfolios and we identify which securities are most likely to have the most climate risks. And then we ask questions. In doing these CPRs, we encountered another issue. The issue was that locational data for companies and for sites is not readily available. We actually have people on staff at Wellington who are using search engines to identify addresses for sites for the companies that we invest in. This is a market inefficiency as well. In fact, maybe key learning number one, capital markets are not pricing in climate risks, is due to the fact that we don't have readily available data to do so, even if we were so inclined. I also mentioned that part of the CPRs was looking at what the company had said about themselves in disclosures and transcripts of conference calls, etc. We do this via human interaction, people actually looking at the reports, and also through natural language processing. And after looking at thousands of securities, we found that for over 90% of securities, the disclosures are insufficient. This leads us to key learning number two. Awareness of, and therefore resilience to, physical climate risks is low. And of course, this is critically important because companies form the basis of economies, and economies form the basis of society. Let's turn to key learning number three. Adaptation and mitigation will be critically important. Unfortunately, we also learned that no matter what we do with regard to mitigation, even though it's critically important and we have to get started right away, no matter what we do, whether we continue on the RCP scenario 8.5, business as usual, or moderate mitigation right now, today, the climate impacts that we will experience over the next 20 years are largely predetermined because of the long half-life of climate emissions, of greenhouse gas emissions. Now, while that's troubling and while it's unfortunate, it's really important to understand because it's the only way that we can create a holistic strategy. We're going to need to work on adaptation and mitigation at the same time. We're going to have to walk and chew gum at the same time, as we like to say. We're going to need to invest in adaptation solutions that's going to help us survive, maybe even thrive in a changing climate, while also prioritizing real-world emissions reductions. These three key lessons to us have been very compelling and have catalyzed our action. First, climate change is not accurately priced by capital markets. Second, awareness of and therefore resilience to climate risks is low. And third, climate adaptation and mitigation are both critical. These have shaped our strategy. They've informed how we engage with companies and with regulators. They've prompted us to create solutions that invest in climate adaptation solutions and climate innovation. And it prompted us to become founding members of the Net Zero Asset Managers Initiative. If capital markets are going to price climate risk information more efficiently and more effectively, we're going to need more data and more awareness. To help with this problem, we created a consultative document that we refer to as PROCC, yet another acronym, PROCC, Physical Risk of Climate Change. We've made this publicly available. We've highlighted it broadly. Our partners in developing this document, CalPERS, have done the same. And in fact, we use the document in engagements with companies where we think physical risks may exist. And within the document, we have another acronym, Delta, that guides the approach. Delta, D, stands for demand. How will your customers' demand change based on new climate risks? How will your customers change based on the geographies they live in and whether or not they'll be impacted by climate risks? E, expenditures. What will you need to spend to shore up your physical plant, to shore up your physical assets, if in fact they are exposed to climate risks? L, logistics. Where are your suppliers located? Will your supply chain be disrupted based on geography, based on exposure to floods or wildfires or hurricanes? T, talent. Same as for your customers, those people that you employ could face those same consequences. Where are they? What are the consequences they might face? How will this change how they're available to you and how you need to be available to them? And last but not least, acquisitions. Certainly, if you're going to do an acquisition, you need to run through this exact same analysis for the company that you're acquiring to identify whether you are, in fact, acquiring more physical climate risks. When we use this document with companies, we actually get a very positive response. We've had some companies take it up in full and do this analysis and report back to us. Beyond PROC, we've also engaged more broadly. We've engaged with the SEC. In March of 2021, the SEC reached out into the marketplace and they said, we have a question, investors. Do you use climate data? What climate data do you need to make better decisions, to help beneficiaries retire, to help generate better investment returns, to help price risks more effectively? We decided to lean into that response. We met with them before they asked. We wrote a detailed letter that's available to you if you're interested about how we use this information, how we would like to use this information, the market inefficiencies we see. And we've spoken to the commissioners and staff roughly 5 times since that. We've asked for Scope 1, Scope 2, Scope 3 emissions data that's comparable and consistent across all issuers. We've asked for physical locational data, and we've asked for harmonization with other emerging frameworks. We expect to see a proposed rule in January of 2022, and we'll be looking to see how much of this they take on. So PROC and engaging with the SEC is really an attempt to address key learnings number 1 and number 2. But what about key learning number 3? Mitigation and adaptation is important. As I mentioned before, no matter what we do on the mitigation side, the climate outcomes that we experience over the next 20 years are largely predetermined. This means that we need to invest in climate adaptation solutions that will help us all live in a changing climate, while we also need to prioritize real-world emissions reductions. So what do we mean by climate adaptation solutions? I spoke to those 6 variables earlier, and if you think through them, you can think about various answers. So for heat, we're going to need more aircon, more air conditioning, more HVAC systems. There are certain geographies that are going to have unlivable temperatures without climate control. Places like India, extreme heat days exceeding livable limits, and the aircon penetration rate in India is less than 10%. This can be very controversial because I'm sure you're thinking, well, if you invest in aircon and if we have more air conditioners, that's going to put more emissions into the atmosphere. And we agree with that. We're going to need to invest in the most efficient solutions. But we also think that we are going to choose to help humanity survive in these changing climate conditions, and we're going to have to find emissions reductions elsewhere. Wildfire. We'll need more backup power, thinking about generator companies. Drought and water scarcity, thinking about water shortage and irrigation technology. Hurricanes, disaster recovery, resilient housing, engineering companies that help us prepare and recover from hurricanes. Flooding, flood defense and stormwater management systems. Now, these are not the typical climate investments that you think of, but they will be critically important going forward. Climate adaptation solutions. I mentioned climate adaptation and mitigation are important. As part of mitigation, we became Net Zero Asset Manager Initiative signatories. And really, the Woodwell Climate Research Partnership was foundational to this commitment. You may be thinking, how could it be foundational if you're focused on physical climate risks in that partnership? And mitigation is more about transition risks. Well, through our understanding of physical risk and understanding that they're occurring now and with more intensity and more frequency, we developed an understanding of the transition itself. The energy transition is unfolding. It will largely be one way. And if anything, we believe it will accelerate as more and more of us experience physical climate risks in our everyday lives and demand action. If this is your base understanding of the transition, then you need the companies that you invest in to have a plan for that transition. In fact, just last week, I was at an event with Janet Yellen, the Secretary of the Treasury for the United States, and she made the most remarkable statement. She said, "This is the most dramatic, predictable economic shift in human history." If this is the most dramatic, predictable economic shift in human history, we need the companies that we invest in on your behalf to have a plan for it. Our net zero commitment means working in partnership with asset owner clients on decarbonization goals and prioritizing real-world emissions by reaching out to companies through company engagements and asking them about their transition plan and asking them to commit to science-based targets to prioritize real-world emissions reductions. I've talked about how the 3 key learnings really impacted our strategy, but let's think about how you can incorporate them into yours. First, ask questions about climate change. If you're an asset owner, ask your external PMs all of these questions that we've been talking about. How are you thinking about physical climate risk? How much do you think it's priced in? What type of data are you using? Do you think the companies you're investing in are aware? How do you think about sovereign debt? All of these questions to prompt that thinking, to build that awareness. And if you have internal management, consider using a framework like PROC or another one of your own design to do those engagements to build that awareness and resilience with the companies themselves and to understand the companies more deeply. Number 2, engage with regulators. We encourage you to join us. Ask them to ask companies to disclose their climate data, Scope 1, Scope 2, Scope 3 emissions, locational data, and to harmonize their asks with frameworks that are emerging around the globe so that we can operate in a globally coordinated way. Number 3, invest in climate-aware portfolios, in your core portfolios from equities to fixed income, to real estate to hedge funds. Ask for climate awareness. Ask for it to be embedded. Number 4, consider allocations to portfolios that fund climate solutions, adaptation, and mitigation solutions. And number 5, set a net zero goal and work with your asset managers to execute it, preferably by prioritizing real-world emissions reductions. As the African proverb says, if you want to go fast, go alone. If you want to go far, go together. We hope by sharing our 3 key learnings with you today that you can build more climate resilience into your investment strategy. Thank you.